Before we dive in, a quick but important disclaimer. The information provided in this video is for educational and informational purposes only. It is not intended to be, and should not be construed as financial, legal, or investment advice. I am not a licensed financial advisor, and you should always consult with a qualified and licensed professional before making any decisions about your personal finances or insurance policies. Your financial situation is unique, and any decisions you make should be based on your own research and the guidance of a professional who understands your specific circumstances. The life insurance policy you bought to protect your family might be in serious trouble. You see that piece of paper, that promise you paid for, you probably think of it as a rock. A solid, unchangeable guarantee in a chaotic world. But what if I told you that for millions of Americans, that rock is sitting on ground that's starting to shake? And the tremors are coming directly from the Federal Reserve. You did the responsible thing. You got the policy. You pay your premiums on time, every single month. You sleep a little better at night knowing that if the worst happens, your loved ones are taken care of. The mortgage is paid. The kids can go to college. A legacy is secure. But an invisible force, one that dominates the headlines but rarely gets connected to your personal life, is quietly changing the math behind that promise. I'm talking about interest rates. For years, we lived in a world of near zero interest rates. It was the new normal. But that era is over. The Fed has been aggressively hiking rates to fight inflation, and while we all feel that at the gas pump and the grocery store, the real, hidden impact is on the massive multi-trillion-dollar institutions that hold our financial futures in their hands, especially life insurance companies. And here's the terrifying truth. Most people, and maybe even most insurance agents, don't fully understand the danger this poses to certain types of policies. They see the stock market go up and down, they get it. But the bond market? Interest rates? Feels like abstract, boring economics. It's not. It's the foundation of the entire system, and that foundation is being completely reformed. So what does this mean for you? It means the cash value in your whole life policy might not be growing the way you were promised. It means the stability of the very company that wrote your policy could be tested in ways it hasn't been for a generation. It could even mean that the universal life policy you thought was funded for life could suddenly require thousands more in premiums just to keep from collapsing. This isn't scaremongering. This is a wake-up call. Because the rules of the financial game have changed. And if you don't understand the new rules, you're at risk of losing. In this video, I'm going to pull back the curtain on the life insurance industry. We are going to cut through all the jargon and the complex financial speak. I'm going to give you a crystal clear understanding of exactly how rising interest rates are creating a perfect storm. You will learn the fundamental way an insurance company actually makes its money, and why that business model is now under enormous pressure. I will break down the 3 specific types of life insurance policies that are most vulnerable in this new environment. And most importantly, by the end of this presentation, you will have a simple, actionable checklist, the exact questions you need to be asking your agent, and the specific red flags you need to look for in your own policy statement. My goal is to empower you, to turn your anxiety into action, so you can be confident that the promise made to your family is one that will actually be kept, no matter what happens in the economy. Alright, let's get into it. First, you have to understand that a life insurance company isn't just a vault where they store your premium payments. That's not how it works. Think of it more like a giant, incredibly conservative investment firm. When you pay your premium, whether it's $100 a month or $1,000, you're not just buying a death benefit. You're giving the insurance company capital. They take your money, and the money from millions of other policyholders, and they pool it together into a colossal fund. We're talking billions, sometimes hundreds of billions of dollars. Their job is to invest that massive pool of money and earn a return. The profit they make from those investments is what allows them to pay for their operations, build up their reserves, and most critically, pay out the death claims to families when the time comes. The entire business model is based on a simple spread: the amount they earn on their investments versus the amount they've promised to pay out to policyholders. For decades, this model worked like a well-oiled machine. So, where do they invest all this money? They can't just throw it into risky tech stocks or cryptocurrency. They are legally and ethically bound to be conservative. Their primary goal is safety and predictable returns, not wild growth. Their investment of choice, the bedrock of their entire portfolio, has always been bonds. Specifically long-term, high-quality corporate and government bonds. Now, here's the single most important concept you need to grasp to understand this entire situation. It's the relationship between interest rates and the value of a bond. Imagine a seesaw on a playground. On one end of the seesaw, you have interest rates. On the other end, you have the price or the value of existing bonds. When one goes up, the other must go down. They have an inverse relationship. It's a fundamental law of finance. Let's make it real. Imagine 5 years ago, your insurance company bought a $10 million government bond that pays a 2% interest rate. At the time, that was a pretty standard safe return. For years, that bond dutifully paid them their 2% interest. But now, the Federal Reserve has jacked up interest rates. A brand new bond issued today might pay 5%. So what happens to that old 2% bond the insurance company is holding? Suddenly, it's not very attractive. Why would any investor want to buy their old crummy 2% bond when they could go out and buy a shiny new 5% bond for the same price? They wouldn't. The only way for the insurance company to sell that old bond is to offer it at a steep discount. The face value might be $10 million, but its actual market value, what someone would pay for it today, has plummeted. It might only be worth $8 or $9 million now. Now, multiply that effect by billions and billions of dollars. Life insurance companies are sitting on vast portfolios filled with these older, low-yield bonds. On paper, they have what are called unrealized losses. As long as they don't have to sell the bonds, it's just a number in an accounting column. They can simply hold the bond until it matures and get their original investment back. But what happens when there's a shock to the system? What happens if a lot of people decide to surrender their policies and ask for their cash value back all at once? Or what if there's an unexpected wave of death claims like we saw during the pandemic? The company might be forced to sell those old bonds at a massive loss to generate the cash they need to pay out. This is the exact same dynamic that caused Silicon Valley Bank and other regional banks to collapse. They were forced to sell their devalued bond portfolios to meet customer withdrawals, and the losses were so huge it wiped them out. Now let me be very clear. Life insurance companies are not banks. They are much more heavily regulated. They have stronger capital requirements, and their liabilities when they have to pay claims are generally more predictable than a bank run. The odds of a major, reputable life insurance company going completely insolvent are very, very low. But that's not the real story here. The immediate risk isn't that your company will disappear overnight. The real, more subtle danger lies in how this immense financial pressure forces them to change their behavior, and how those changes directly impact the promises they made to you in your policy. The pressure on their balance sheets is immense. It affects their profitability, their credit ratings from agencies like Moody's and AM Best, and their ability to offer competitive features on new policies. More importantly, for the policies already in force, it can be a slow-motion crisis. The guarantees you thought were ironclad might have more flexibility than you realize, and the company might start using that flexibility to its advantage to shore up its own financial position, potentially at your expense. And that's where we need to start looking closer at the fine print of your specific policy. Let's start with the big three: term, whole life, and universal life. Understanding the fundamental difference between them is the key to knowing if you should be concerned, or if you can just sit back and relax. First up, the simplest and most common type, term life insurance. Think of it like renting an apartment. You pay a fixed amount of rent, your premium, for a specific period of time or term, say 20 or 30 years. If you pass away during that term, your family gets the keys to the kingdom, a tax-free death benefit. If the term ends and you're still alive and well, the agreement is over. You stop paying and the coverage ends. It's straightforward, it's temporary, and it's pure protection. So, how do rising interest rates affect your 20-year term policy? The short answer is, they don't. Not really. Your premium is locked in. The death benefit is locked in. The contract is set in stone. You are almost completely insulated from the drama of the Federal Reserve and the bond market. The insurance company set your rate years ago based on the interest rates and their financial projections at that time. What happens now is their problem or their gain, not yours. Your payments won't go up and your coverage won't go down. So, if you're one of the millions of Americans with a simple term policy, you can take a deep breath. You're in the safe zone. But this is where the story gets a lot more complicated. We need to talk about permanent life insurance. This is where the real impact of interest rates is felt. The two main players here are whole life and universal life. Unlike term, which is like renting, permanent insurance is like buying a house. You're building equity. In addition to the death benefit, these policies have a savings or investment component called cash value. A portion of every premium you pay goes towards the cost of the insurance itself, and another portion goes into this cash value account, which is designed to grow over time. And it's the performance of this account that is directly tied to the world of interest rates. Let's look at whole life first. This is the old-school, traditional form of permanent insurance. It's built for stability. You have a fixed premium that you pay for your entire life, a guaranteed death benefit, and here's the most important part: a guaranteed minimum rate of growth on your cash value. That guarantee is the bedrock of the entire policy. The insurance company is legally obligated to credit your cash value with at least that minimum rate, no matter what the economy is doing. So, where do they get the money to pay for that guarantee? They take the premiums from you and millions of other policyholders and invest them, primarily in very safe, conservative, long-term investments like high-grade corporate bonds. For the last decade, as the Fed kept interest rates near zero, the yields on these safe bonds were incredibly low. This put a massive squeeze on the insurance companies. They were still on the hook for their guarantees, but the money they were making from their investments was dwindling. Now the tables have turned. Interest rates are up. This means that every new dollar in premium they receive can be invested in new bonds that pay a much higher return. And as their old, low-yielding bonds mature, they can reinvest that money at these new, higher rates. Think of it like a giant aircraft carrier. It takes a very long time to turn, but it is turning. The insurance company's overall portfolio yield is slowly but surely starting to climb. What does that mean for you, the whole life policyholder? Well, your guaranteed growth rate isn't going to change. It's a contractual minimum. But many whole life policies, especially from mutual insurance companies, are participating policies. This means that if the company performs better than they projected, if their investments do well, their mortality costs are lower than expected, and their expenses are in check, they can share that surplus with you in the form of a dividend. Now, this isn't a dividend like you get from a stock. It's legally considered a return of an overpayment of premium. You can take it as cash, use it to pay your premiums, or, and this is very popular, use it to buy small paid-up additions of more insurance, which further boosts your death benefit and cash value. For the past decade, because of low interest rates, these dividend payments have been under pressure. Many companies have had to lower them, but with rates rising, there's a new optimism. As the insurance company's investment portfolios start generating higher returns, the likelihood of them being able to maintain or even increase those non-guaranteed dividends in the future goes up. It won't happen overnight. It might take several years for the effect to ripple through their massive bond portfolios. But for whole life policyholders, rising interest rates are generally a long-term positive. It strengthens the company behind your policy and creates the potential for better dividend performance down the road. Okay, now we need to enter the danger zone. We need to talk about universal life, or UL, and its more complex cousins like indexed universal life, or IUL. This is where the flexibility we talked about earlier can become a double-edged sword, and where rising interest rates have a much more complex and potentially negative effect. Universal life was designed to be more flexible than whole life. You can often vary your premium payments and sometimes even adjust your death benefit. But the cash value growth is also different. Instead of a hard and fast guarantee like in whole life, the cash value in a UL policy is credited with an interest rate that the insurance company can change periodically, usually every year. There's typically a guaranteed minimum floor, maybe 2% or even 0%, but above that, it's up to the company. When you bought your policy, you were probably shown an illustration, a projection of how it might perform. That illustration likely assumed a crediting rate of, say, 5 or 6%. It showed your cash value growing into a beautiful mountain of money over time. But for the last decade of near-zero interest rates, the reality has been very different. Most companies have been crediting policies at or very near their minimum guaranteed floors. That mountain of cash value never materialized for many people. So you might think, great, interest rates are rising, so the insurance company will start crediting my policy with a higher rate, and my cash value will finally start to grow. But this is a critical misunderstanding, because there is another, far more powerful force at work inside your policy: the cost of insurance. The cost of insurance, or COI, is the silent killer of many universal life policies. It's the pure, underlying cost for your death benefit, and it's deducted from your cash value every single month. And here's the part that nobody likes to talk about: the COI is not level. It increases every single year as you get older. The cost to insure a 45-year-old is low. The cost to insure that same person at 75 is astronomical. The entire design of a UL policy is based on a race. In the early years, the goal is for your interest credits and premium payments to significantly outgrow the low, early-year COI charges. This builds up your cash value. That cash value then acts as a buffer, a self-funding mechanism for the later years. when the COI charges become enormous. The hope is that the cash value will be large enough to pay for those massive internal costs and keep the policy from collapsing under its own weight. But after a decade of low-interest credits, that cash value buffer is much smaller than originally projected for millions of policyholders. The race is being lost. And now, even if the insurance company does raise the crediting rate a little bit, they have another lever they can pull. Your policy contract gives them the right to charge you a cost of insurance rate anywhere between their current rate and a much higher guaranteed maximum rate. For years, to stay competitive, most companies have been charging the current lower rates. But as they face their own financial pressures with old low-yielding bonds still on their books, they have the contractual right to increase those internal charges on you, all the way up to the maximum stated in the fine print. This is the trap. You might see a headline that your policy's crediting rate is going up from 2% to 3%, and you think you're winning. But if, behind the scenes, the company also increases the internal COI charges by a similar or even greater amount, you're actually falling further behind. Your policy is eating itself alive from the inside, and the rising interest rate environment gives the company the perfect cover to adjust their internal pricing to shore up their own books, potentially at your expense. Your policy is getting more expensive every year as you age, and it hasn't accumulated the cash it was supposed to in order to pay for those future costs. This is a recipe for disaster. And the scariest part? Most people have no idea this disaster is unfolding silently in their financial statements. They see the words life insurance and think safety. They think guarantee. But for millions of Americans with certain types of policies, that safety is an illusion, a mirage created a decade ago in a world that no longer exists. The policies I'm talking about are primarily universal life, and especially its more complex cousin, indexed universal life, or IUL. These were sold by the truckload over the last 15 years, often pitched as a sort of Swiss Army knife of finance, a death benefit, a tax-free retirement account, a college savings plan, all rolled into one. The sales pitch was intoxicating. The illustrations, those glossy pages showing your money growing at a steady 7 or 8%, looked like a sure thing. But those illustrations were based on a crucial assumption, that interest rates would behave, that the market would perform, and that the insurance company's costs would remain stable. Well, none of that happened. To understand the ticking time bomb, you have to think of your policy like a bucket. Let's call it your cash value bucket. Every month, you pour water into this bucket. That's your premium payment. The insurance company also adds a little water. That's the interest they credit to your account. But this bucket has a hole in the bottom. Pretty big one, actually. Every single month, water leaks out. That leakage is the cost of the actual life insurance, what we call the cost of insurance, or COI. It also includes administrative fees and other charges. The whole design of the policy is based on a simple idea. You and the insurance company need to pour enough water in the top, premiums and interest, to cover what's leaking out the bottom, costs and fees, with enough left over to build up a nice big reservoir of cash for the future. When you're young, the hole in the bucket is tiny. The cost to insure your life is cheap. But as you get older, that hole gets bigger, and bigger, and bigger. The cost of insurance for a 75-year-old is exponentially higher than for a 45-year-old. The entire plan relies on your cash value bucket being so full of water from the early years of high premiums and compound interest that it can easily handle the massive leakage in your later years. But what happened? For over a decade, we lived in the ZIRP era, the zero interest rate policy world. The Federal Reserve kept interest rates near zero. This starved these life insurance policies of the interest water they were supposed to receive. The insurance companies, who invest your premiums primarily in conservative, fixed-income assets like high-grade corporate bonds, were earning next to nothing. So, the water they were adding to your bucket was just a trickle. The illustrations might have shown a steady stream of 7% water, but in reality many policies were getting 2%, 1%, or sometimes even a guaranteed minimum of 0%. Meanwhile, the hole in the bottom of the bucket, the cost of insurance, kept getting bigger every single year as you got older. So for 10 years your bucket wasn't filling up. In fact, for many people, the water level was slowly but surely dropping. The reservoir you were supposed to build to pay for those hugely expensive later years, it never got built. You were paying your premiums, but the policy was just treading water or slowly sinking. Now let's fast forward to today. The Fed has jacked up interest rates at the fastest pace in history. Suddenly, those same insurance companies can now take your premium dollars and invest them in bonds yielding 5 or 6%. Logic would suggest this is fantastic news for you, the policyholder, right? The insurance company is finally earning more. so they can start pouring more interest water into your bucket. Your cash value should start to soar, finally catching up to where it was supposed to be. But this is where the gut punch comes in. It's the cruel irony of the situation. The insurance companies have a secret weapon, a lever they can pull that's buried deep in the 80-page contract you probably never read. They have the right to change the cost of insurance. They can make the hole in the bottom of your bucket bigger. And many of them are doing exactly that. They're justifying it by saying things like, our portfolio of old, low-yield bonds from the last decade is still dragging down our overall returns. Or our long-term expectations about mortality have changed. In plain English, they're saying, we miscalculated. We got hammered by a decade of low rates, and now, just as we're starting to make real money again, we're not going to pass all those gains on to you. We're going to use this opportunity to shore up our own balance sheets by increasing your costs. So you get hit with a devastating 1-2 punch. First, a decade of anemic growth where your cash value stagnated because interest rates were too low. And now, just as rates rise and your policy finally has a chance to recover, the company increases the internal fees, effectively scooping that newfound growth right out of your bucket before you ever see it. The hole in the bottom of your bucket just got bigger, canceling out the extra water being poured in the top. You're stuck. The policy is underfunded from a decade of low rates, and now it's being bled dry by rising internal costs. This isn't a theoretical problem. This is happening right now. People are getting their annual statements in the mail and seeing that their cash value, which was supposed to last their entire life, is now projected to run out when they're 78 or 82. The policy is projected to lapse, to implode under the weight of its own escalating costs, leaving them with nothing. No death benefit for their family, and all the premiums they paid for 20 years? Gone. Vanished. And if there's a loan against the policy, gets even worse. A lapse policy with an outstanding loan can trigger a massive unexpected tax bill. A phantom income tax on money you never even really touched. It's the ultimate nightmare scenario. You lose your insurance coverage, you lose all the money you paid in, and you get a giant bill from the IRS for your troubles. We are on the precipice of a massive wave of policy failures, a crisis that was seeded in the low interest rate environment of the 2010s and is now being triggered by the rapid rise in rates today. Your policy's illustration from 2015 isn't just outdated, it's a work of pure fiction. The promises made in a different economic world are now being broken in the fine print. But the insurance company increasing your costs is only the first danger. There's a second, more hidden threat lurking inside your policy's fine print, a no-lapse guarantee that might not be the safety net you think it is. In fact, it could be the very thing that makes your policy implode even faster. So let's pull back the curtain on this so-called guarantee. When universal life insurance policies first became popular, they were sold on the promise of flexibility. You could pay more, you could pay less, and the cash value would grow based on market interest rates. But after the dot-com bubble burst in the early 2000s, people were terrified. The idea of a life insurance policy that could just disappear because of a market crash was a nightmare. The insurance industry needed a solution, a marketing silver bullet to restore confidence. And they found one, the no-lapse guarantee, or NLG. The sales pitch was brilliant in its simplicity. Look, the agent would say, forget all that complicated stuff about cash value and interest rates. Just pay this one low fixed premium every year, and we guarantee this policy will stay in force until you're age 90, 95, even 121. It can't lapse. It's guaranteed. For a public tired of uncertainty, this was music to their ears. It sounded like they were getting all the upside of a flexible policy with the stability of a traditional whole life policy. But it was a masterful illusion, built on a concept most policyholders have never even heard of: the shadow account. You see, your policy doesn't just have one account. It has two. There's the one you know about, your real cash value account. This is the account that receives your premiums, earns interest, and has the policy's costs deducted from it. It's the account that's supposed to grow over time. But hidden from view, running in parallel, is a second, completely separate ledger: the shadow account. This account is a fiction, a hypothetical calculation that exists for one reason and one reason only: to determine if your no-lapse guarantee is still active. Think of it like this. Imagine you buy a car with a special engine for life warranty. The manufacturer says, as long as you put exactly 5 gallons of our special, premium fuel in the tank every single week, we guarantee the engine will never fail. Now, you know your car actually needs, say, 10 gallons a week for your daily commute. But you think, Why pay for 10 when the warranty only requires 5? So every week you put in just 5 gallons. What happens? The warranty company looks at their secret logbook, their shadow account, and sees, yep, he put in 5 gallons. The warranty is active. But what's happening to your actual gas tank? It's running on fumes. You're not putting in enough to cover what the car is actually using. The car is draining its reserves, and one day, you'll be coasting to a stop on the side of the highway, completely out of gas. You call the warranty company furious and they say, well, the engine didn't fail, did it? The warranty is for the engine, not the gas in the tank. You're on your own. That is exactly what happens with a no-lapse guarantee. The minimum premium you're told to pay isn't designed to fund your policy. It's designed to do the absolute bare minimum to keep the shadow account from hitting zero. It's the 5 gallons of gas in our example. Meanwhile, the real costs of your policy, the cost of the insurance itself, the administrative fees, the premium charges, are the 10 gallons your car actually needs to run. So every month, you pay your guaranteed minimum premium. Let's say it's $300. But the true cost to keep your policy running for that month is actually $450. Where does that extra $150 come from? It's cannibalized directly from your real cash value. The insurance company sucks it right out of your savings to cover the shortfall. Month after month, year after year, you're paying just enough to keep the guarantee alive on paper, while your actual tangible cash value is being systematically hollowed out, drained to nothing. You think you're funding a death benefit, but you're really just treading water, and the water level is dropping fast. This is where rising interest rates turn a bad situation into a catastrophic one. Remember, these policies were sold during a period of relatively low and stable interest rates. The calculations for that minimum premium were based on a certain set of assumptions, that the interest credited to your policy would be around 3 or 4%, and that the internal costs of insurance would remain stable. But what happens when those assumptions get thrown out the window? As we've discussed, insurance companies have the right to increase the cost of insurance, the actual price you pay for your death benefit coverage, up to a guaranteed maximum. When their own investment returns are squeezed or they see an opportunity to improve profits on older, less profitable blocks of business, they pull that lever. And a period of rapidly rising interest rates gives them the perfect cover to do so. Suddenly, the internal costs of your policy don't just creep up, they skyrocket. That $450 a month in true costs might jump to $550 or $650. But you're still paying the same old minimum premium of $300 because that's what your statement says, that's what the guarantee requires. The shortfall, the gap between what you're paying and what the policy needs, has now doubled. The speed at which your cash value is being devoured accelerates exponentially. It's like the slow leak in your tire just became a massive gash. For years, you have no idea this is happening. You get your annual statement, you see the line that says no lapse guarantee active, and you file it away, confident that your family is protected. You are doing exactly what you were told to do, but you are piloting a ghost ship. The sails are up, it looks fine from a distance, but below decks, the hull has been completely eaten away. And then comes the day of reckoning. For many of these policies, the no-lapse guarantee isn't permanent. It expires. It might be at age 90 or 95 or 105. The moment that guarantee vanishes, the policy's entire support structure disappears. It's no longer running on the fictional shadow account. It has to survive on its real cash value. And when the policy looks inside for that cash value, it finds nothing but dust. The policy is now a house of cards in a hurricane. With no cash value to pay the massively inflated internal costs, it immediately triggers a lapse warning. You, now in your 80s or 90s and likely on a fixed income, receive a certified letter in the mail. It's not a statement, it's an ultimatum. It says your policy is about to terminate, and to prevent this, you must immediately pay a catch-up premium of, say, $40,000. And your new annual premium going forward won't be the $3,600 you've been paying for decades. It will be $25,000 a year. It's an impossible, heartbreaking choice. After a lifetime of diligent payments, you're told the promise was a mirage. The safety net you paid for was designed to let you fall through. You either drain your retirement savings to rescue a policy that was designed to fail, or you walk away with nothing, losing every single dollar you ever paid in. The death benefit your spouse or your children were counting on evaporates into thin air. This isn't a rare occurrence. It is the built-in pre-programmed self-destruct sequence for millions of these policies across the United States. The no-lapse guarantee wasn't a shield to protect you. It was a blindfold to prevent you from seeing your own policy's slow and deliberate implosion. So So how can you tell if your policy is one of these ticking time bombs? It starts with looking at your annual statement, but the most important numbers are often buried in plain sight, disguised by confusing labels. I'm going to show you exactly what to look for, the 3 specific columns on your statement that reveal the truth, and the one critical question you absolutely must ask your agent, a question that will instantly tell you if they're on your side or the company's. Alright, let's pull back the curtain. I want you to find your most recent annual life insurance statement. Seriously, if you need to pause this video, do it. Go to that filing cabinet, that drawer of important stuff, or log into your online portal. What we're about to do is too important to leave to memory. This piece of paper, which most people glance at for 5 seconds before filing it away, holds the entire story of your policy's health. It's a financial EKG, and today you're going to learn how to read it. Most people make the same mistake. They scan the document, their eyes land on one big, friendly number, usually labeled total cash value or accumulated value, and they think, okay, it went up from last year. Looks good. And they move on with their life. That is exactly what the insurance company hopes you'll do, because that one number tells you almost nothing. It's like judging the health of a company by only looking at its total revenue. It ignores expenses, debt, and the cost of doing business. To understand the truth, you need to look at the numbers behind the number. And there are 3 columns, 3 specific figures on that statement that will tell you everything. The first column you need to find is the guaranteed cash value. This is the single most important number on your statement, yet it's the one most often ignored. Think of this as the bedrock, the concrete foundation of your policy. This is the amount the insurance company has contractually promised your cash value will be worth, even if their investments tank, even if the economy goes into a free fall, even if they never pay a single penny in dividends ever again. It's based on a very low guaranteed interest rate, usually somewhere between 2 and 4%, that was baked into the contract the day you signed it. Now, why is this so critical in a rising interest rate environment? Because this number doesn't care about the Federal Reserve. It doesn't care about the company's investment performance this year. It is the absolute, legally binding worst-case scenario. It's your safety net. And if you have a policy that's been around for a while, from a time when rates were higher, that guaranteed rate might actually be pretty decent. But for most policies sold in the last 20 years, this guaranteed value grows very, very slowly. It's the floor, the promise. And seeing how far your actual cash value is from this floor is the first step to understanding how much of your policy's performance is real and how much is just smoke and mirrors. Now find the second column. It'll be called something like non-guaranteed cash value, or maybe more simply current cash value. This is the number everyone looks at. This is your guaranteed value plus all the extras. The extras are the dividends or the excess interest credits that the company has decided to share with you over the years. This is where the magic is supposed to happen. When the Fed raises rates, the insurance company takes your premiums, invests them in their general account, which is mostly high-quality corporate bonds, and they earn a higher return. In theory, a good, ethical mutual insurance company sees those higher returns and says, "Great! Our policyholders are the owners of this company. Let's pass a big chunk of these extra earnings back to them in the form of a higher dividend." This increases the non-guaranteed cash value. It makes your statement look great. It makes you feel good. It makes your agent look smart. But here's the catch. The dividend is completely discretionary. They don't have to raise it. And even if they do, it doesn't tell the whole story. Because there's a third, almost invisible element at play. A financial vampire that is silently draining your cash value every single month. This brings us to the third and most revealing number you need to find. It's often buried in the fine print or on a detailed subpage. You're looking for the cost of insurance, sometimes called the mortality and expense charge or M&E. This is, without a doubt, the most misunderstood part of a permanent life insurance policy. This is what you are actually paying for the death benefit. Let me be crystal clear. When you pay your premium, that money doesn't just go into a high-yield savings account with your name on it. The very first thing the insurance company does is reach in and take out the cost of insuring your life for that year. And here is the brutal truth that many agents conveniently forget to mention. That cost of insurance is not a fixed number. It is designed to increase every single year you are alive. Why? Because every year you get older, you are statistically 1 year closer to death, making you more expensive to insure. It's a tiny amount when you're 35. It's manageable when you're 45. It starts to get noticeable when you're 55. And by the time you're 65 or 70, that internal cost can become a monster, eating away at your cash value with ferocious speed. So now let's connect the dots to today's rising interest rates. An insurance company might make a big public announcement. We're raising our dividend rate. Great news for our policyholders. And your non-guaranteed cash value might get a nice bump. But at the same time, they have the contractual right to adjust the internal cost of insurance charges based on their mortality experience. It's a black box. They can essentially give you a raise with one hand by increasing the dividend, while simultaneously increasing your expenses with the other by raising the mortality charges. The net effect on your actual cash value growth could be zero or even negative. You could be earning a higher dividend rate but be poorer at the end of the year because the cost of insurance ate up all the gains and then some. This is the shell game. They get the positive headline of a dividend increase, while the mechanism that could be gutting your policy remains hidden in the fine print. So you have to look at all three: the guaranteed value, the promise; the non-guaranteed value, the current reality; and the cost of insurance, the hidden expense. Only then can you see if the rising tide of interest rates is actually lifting your boat, or if you're just taking on water faster than ever. So how do you cut through the complexity? How do you get a straight answer? You do it by asking your agent one single, devastatingly effective question. A question so precise it leaves no room for waffling, for sales speak, or for misdirection. Don't ask, "How's my policy doing?" That's an invitation for a vague, happy talk answer. Don't ask, "What's the dividend this year?" As we've seen, that number alone is almost useless. Here is the question. Write it down. Memorize it. Can you please provide me with an in-force illustration showing my policy's performance projected forward, using the current dividend rate and the current cost of insurance charges, and a second illustration using the guaranteed assumptions only? Let's break down why this is a silver bullet. In-force illustration means it's not a generic sales brochure. It's a projection based on your specific policy, with its current cash value, loan balance, and history. It's a custom report about you. Projected forward means you're not just looking at the past, you're looking at the future. You'll see a year-by-year spreadsheet showing how your cash value and death benefit are expected to perform over the next 10, 20, 30 years. Using the current dividend rate and current cost of insurance shows you the best-case, present-day scenario. If things continue exactly as they are today, where will you be? And now the kill shot. And a second illustration using the guaranteed assumptions only? This is the truth serum. This report strips away all the optimistic, non-guaranteed dividends and shows you the raw, contractual promise. It projects the future using only the guaranteed interest rate and the maximum allowable cost of insurance charges. This is the worst-case scenario the insurance company is legally allowed to deliver. The response you get to this question will tell you everything you need to know about your agent and your policy. A great agent, a true fiduciary who is on your side, will say, "Absolutely. That's a smart request. I'll have those for you by the end of the day, and we can schedule a call to review them together." They are confident in the product they sold you and welcome the transparency. But an agent who sold you a ticking time bomb, or who is more loyal to their commission than to your financial health, will squirm. They'll deflect. You'll hear things like, "Oh, nobody ever looks at the guaranteed illustration. Those numbers are artificially low and don't mean anything." Or, "That's a very complicated report to run. Let's just focus on the great performance we're seeing now." That hesitation, that deflection is a massive red flag. It's a sign that they know the guaranteed illustration looks terrifying. It might show your policy completely running out of money and lapsing in your 70s or 80s, the very time you need it most. They don't want you to see it. This one question cuts through all the noise. It forces transparency, puts the power back in your hands. But what do you do once you have these two illustrations in your hands? How do you read them? What if the news is bad? What if the guaranteed column shows your policy self-destructing in 10 years? In the next part, we will break down exactly how to interpret these documents, the warning signs that scream danger, and the 3 specific strategies you can use to fix a policy that's headed for disaster. Okay, you've requested that in-force illustration from your insurance company. A week later, a thick, intimidating envelope lands in your mailbox. You open it, and it looks like a spreadsheet designed by a rocket scientist. Columns of numbers, fine print, and jargon like non-guaranteed elements and crediting rate. Your first instinct is to toss it on the pile of, "I'll get to this later" mail. Do not do that. This document is the EKG of your financial life. It's telling you whether your policy is healthy, sick, or on its way to the ICU. And today you're going to learn how to read it like a seasoned pro. First, let's demystify what this thing actually is. An in-force illustration is not a bill. It's a projection. It's the insurance company's supercomputer running a what-if scenario based on two different futures for your policy. You'll see two main columns of numbers that matter, and they are usually labeled guaranteed and current or non-guaranteed. Let's start with the guaranteed column. Think of this as the absolute rock-bottom worst-case scenario. This is the insurance company saying, if our costs go to the maximum allowed in the contract, and we pay you the absolute minimum interest rate we are legally obligated to pay, this is what will happen to your policy. Most people ignore this column. Their agent might have even told them, "Oh, don't worry about that, it's never going to happen." That is dangerously naive advice. The guaranteed column is the foundation of the promise. If that column shows your policy crashing and burning, meaning the cash value goes to zero and the policy lapses at, say, age 79, you have a structurally flawed product. It's like buying a car and the manufacturer says, well, the engine will probably last 200,000 miles, but we only guarantee it for 15,000. You'd want to know that, right? The same principle applies here. Now let's look at the more important column for our current discussion, the current or non-guaranteed column. This is the optimistic projection. It's based on the insurance company's current cost of insurance charges and the current interest rate they are crediting to your cash value. This is the column that has been changing dramatically over the last decade. 10 years ago, when interest rates were higher, this column probably looked fantastic, showing your policy lasting to age 100 or 121 with no problems. But as the company lowered its crediting rate year after year, that projection has been getting worse and worse. This column is where the silent erosion of your policy becomes visible. So you have these two columns. What are you actually looking for? You're a detective searching for one critical piece of evidence: the policy's self-destruct date. Scan down the age column, year by year, and look at the cash surrender value column. You are looking for the year where that number hits zero. When the cash value hits zero, your policy lapses. It terminates. It's gone. That is the age your policy is projected to die. This is the single most important number on that entire 20-page document. Now let's talk about the specific warning signs, the giant red flags that should have you immediately picking up the phone. Red flag number 1 is the most obvious. The policy lapses before you plan to. If that current projection shows your policy lapsing at age 88, and you come from a long line of healthy 95-year-olds, you have a ticking time bomb. You are paying for something that is statistically likely to fail you when you need it most. You're effectively renting your life insurance, not owning it for life, and the lease is set to expire right when your mortality risk is highest. Red flag number 2 is a wide gap between the guaranteed and current projections. Let's say your current illustration shows the policy lasting to age 105. Great, but then you look over at the guaranteed column, and it shows the policy imploding at age 75. That massive gap is a measure of your policy's risk. It means your policy's success is entirely dependent on the insurance company maintaining its current, non-guaranteed assumptions. It has no safety net. A policy with strong guarantees might show it lasts to age 105 on the current side and say age 95 on the guaranteed side. That's a much safer, more stable contract. A huge gap means your policy is fragile, and any future decrease in crediting rates could be catastrophic. Red flag number 3 is a cash value peak. As you scan down the cash value column year by year, you should see it go up and up. But in an underfunded policy, you'll eventually see it hit a peak, maybe in your late 70s or early 80s, and then it will start to decline. And not just slowly, it will start falling off a cliff. Why? Because at that point, the internal cost of insurance, which remember increases every single year, has become so massive that it's overwhelming the interest credits and your premium payments. The policy is literally eating itself alive. Once you see that peak and the subsequent decline, the policy is in a terminal death spiral. It's no longer a question of if it will lapse, but when. So you've found the red flags. Your illustration shows the policy is projected to lapse at age 90. Your heart sinks. Feels like you've been duped. But this is not the time for panic. It's the time for action. You have options. Here are the 3 primary strategies you can use to rescue a failing policy. Strategy number 1 is the most direct. The premium injection. You simply start paying more. Your policy is underfunded, so the solution is to fund it properly. You need to call your agent or the company and say, please run me a new illustration that shows what premium is required to guarantee my policy lasts to age 100. They can solve for this number. The illustration might show that your current $300 a month payment gets you to age 90, but paying $425 a month will get you to age 100. It's more money out of your pocket, yes, but it may be the difference between your family receiving $1 million and them receiving a lapse notice. This is about reinforcing the foundation of the policy to support the death benefit you originally wanted. Strategy number 2 is what I call the face value haircut. If you can't or don't want to pay a higher premium, this is your next best option. You call the company and request to reduce the death benefit. The single biggest expense inside a policy is the cost of insurance. By lowering the death benefit, say from $1 million down to $700,000, you dramatically reduce that internal expense. This reduction in costs can be enough to stabilize the policy and allow your current premium to carry it for the rest of your life. You'll again ask for an illustration to confirm this. The agent can show you that by reducing the face amount, your existing premium will now carry the policy to age 105. It's a trade-off for sure. You're accepting a smaller death benefit in exchange for certainty. But ask yourself this: is it better for your family to have a 100% chance of receiving $700,000 or a coin flip chance of receiving $1 million or nothing at all? For most people, the certainty is worth the haircut. Strategy number 3 is the most advanced, but often the most effective: the 1035 lifeline. A 1035 exchange is a provision in the tax code that allows you to roll the cash value from your current life insurance policy directly into a new one, without any tax consequences. It's like trading in your old car for a new one. Why would you do this? Because life insurance products have evolved. Newer policies can be dramatically more efficient, with lower internal charges and stronger guarantees than a policy designed 15 or 20 years ago. You could potentially move your cash value into a new policy that gives you the same death benefit, but with an ironclad guarantee that it will never lapse, all while potentially keeping your premium the same or even lowering it. This can be a game changer, but it comes with a critical warning. This is not a do-it-yourself project. It requires a thorough analysis by a truly qualified, trustworthy advisor who can compare your old policy to new ones and determine if it's a suitable move. You may have to prove you're still in good health, and you need to be aware of potential surrender charges on your old policy. But for many people with failing policies, a 1035 exchange is the ultimate rescue mission. You are now armed with the knowledge to read the secret language of your policy illustration. You know the red flags that signal danger, and you have 3 concrete, actionable strategies to fix a policy that's on the brink of collapse. You've moved from being a passive passenger to an empowered pilot of your own financial plan. But knowing what to do is only half the battle. The other half is navigating the conversation with your insurance company or agent to actually get it done. How do you start that call? What specific questions do you need to ask to ensure you're getting the full picture? And how do you spot the sales tactics an agent might use to steer you toward a solution that benefits them more than it benefits you? That's exactly what we're covering next. The first question, and arguably the most important, is this: can you please show me the illustration for this policy based only on the guaranteed values? Let me repeat that. You want to see the performance based exclusively on the guaranteed minimum interest rate and the guaranteed maximum charges. Every life insurance illustration has 2 main columns, one labeled guaranteed and one labeled non-guaranteed or current. The non-guaranteed column is the sales presentation. It's the fantasy. It's what the policy could do if the current, often higher, interest rates continue forever, and the insurance company keeps its internal costs low. It's the beautiful sunny day scenario. The guaranteed column is the contract. It's the legally binding worst-case scenario. It's the financial hurricane. By asking to see the performance based only on these guarantees, you strip away all the optimistic projections and all the salesmanship. You see the absolute bedrock foundation of the policy. If the policy still performs acceptably and doesn't lapse under this worst-case scenario, you might have a solid product. But if it crashes and burns, if it requires massive premium payments down the road or lapses entirely in the guaranteed column, you've just uncovered a fatal flaw that the agent was hoping you wouldn't notice. In a rising rate environment, agents are more tempted than ever to showcase those beautiful non-guaranteed projections. Your job is to ignore the fantasy and focus on the contract. The second question is a stress test. You're going to ask, can you run an in-force illustration showing me what happens if the credited interest rate drops to the guaranteed minimum next year and stays there, while the cost of insurance simultaneously rises to the guaranteed maximum? This is the advanced version of the first question. It simulates a sudden economic shock. This reveals the policy's breaking point. How quickly does the cash value start to deplete? How many years would it take for the policy to be in danger of lapsing? Does it require you to suddenly start paying thousands more in premiums just to keep it alive? An agent who is confident in their product will have no problem running this for you. An agent who is selling a house of cards built on rosy assumptions will start to squirm. They might say it's an unrealistic scenario. Your response should be, perhaps, but the whole point of insurance is to protect against worst-case scenarios, not just hope for the best. I need to see if this policy can survive the storm. Third, you must dig into the engine room of the policy with this question. Can you show me the schedule of the cost of insurance charges? I want to see the current charges and the maximum guaranteed charges, year by year. People get mesmerized by the interest rate being credited to their cash value, but they completely forget about the costs being deducted every single month. The net result is what matters. In many universal life policies, the internal cost of the pure insurance, the death benefit, is not level. It starts low when you're young and healthy, and it can increase dramatically as you get older. An agent might show you a projection where your cash value grows so fast that it easily covers these rising costs. But what if the interest credits don't keep up? If you're only looking at the interest rate, you're only seeing half the equation. You need to see the schedule of fees and charges that will be working against your cash value for the rest of your life. Seeing that schedule of maximum charges can be a truly eye-opening experience. Finally, the fourth question is the one most people are afraid to ask, but it's essential for understanding the agent's motives. You ask, directly but politely, "Could you explain how you are compensated for selling me this policy?" A true professional will not be offended. They'll explain their commission structure. What you're looking for is insight into their incentives. Is there a massive front-loaded commission in the first year? This can incentivize an agent to sell you the biggest, most expensive policy possible, even if it's not the right fit. Is their compensation more spread out over time? That might suggest an incentive structure that's more aligned with your long-term success. This isn't about accusing anyone of being greedy. It's about understanding the financial dynamics at play. It helps you understand why they might be recommending one product over another. Transparency here is a huge green flag. Evasiveness is a massive red one. Now, armed with those questions, let's talk about how to spot the sales tactics that are designed to bypass your critical thinking. The first and most popular one you'll encounter is the "be your own bank" or infinite banking pitch. The narrative is intoxicating. They'll tell you that you can overfund a specially designed whole life policy, build up a huge cash value, and then borrow against it tax-free to buy cars, invest in real estate, or fund your retirement. It's presented as a secret financial tool of the wealthy. Here's the reality check. Policy loans are a real and valuable feature, but it is not free money. When you borrow from your policy, the insurance company charges you interest. Even if it's a zero net cost loan, there is an opportunity cost because the money you borrowed is no longer earning interest or dividends inside the policy. The illustrations used to sell this concept are almost always based on aggressive, non-guaranteed assumptions. The moment you ask them to show you how infinite banking works using only the guaranteed column, the entire strategy often falls apart. If a presentation sounds more like a get-rich-quick scheme than a tool for death benefit protection, your alarm bells should be ringing. The second tactic is more subtle. It's the finger on the page trick. The agent will have the 50-page illustration in front of you. They'll flip right to page 27, and they'll point their finger directly at the non-guaranteed column, showing a massive projected cash value at age 85. They'll say things like, "Look at this. Your $100,000 premium could turn into $1 million of tax-free cash." Their finger and your attention is deliberately focused on the most optimistic number on the page. They will talk quickly and excitedly about this column, while completely ignoring the guaranteed column just a few inches to the left, which might show the policy lapsing with zero value at age 78. Because you're now armed with our critical questions, you can be the one to slide their finger over and say, "That's a great projection, but what about this guaranteed column here? Let's talk about that." You'll immediately take control of the conversation. Third, listen for the term is a waste of money argument. The pitch goes like this. Why would you rent your insurance with a term policy when you could own it with a permanent policy? If you outlive your term policy, you get nothing back. You've just thrown all that money away. This is a profoundly misleading analogy. Term insurance isn't a waste of money any more than your car insurance is a waste if you don't get into an accident. Its job is to provide the maximum amount of protection for the lowest cost during the years you need it most. When your kids are young and your mortgage is high, the purpose isn't to get a return. The purpose is peace of mind and family security. This argument is designed to make you feel foolish for considering the most cost-effective solution and steer you toward a product that is 10 to 20 times more expensive and carries a much higher commission for the agent. Finally, beware of the high-pressure time crunch. This is the oldest sales tactic in the book. You'll hear things like, "The cost of insurance is set to increase next month, so we need to lock this in now," or "This favorable illustration is only good until Friday." While it's true that your age and health class affect your rates, these are often used to create a false sense of urgency. They want to rush you into making a decision before you have time to do your research, get a second opinion, or simply sleep on it. A quality financial product will still be a quality financial product next week. Your response should always be calm and firm. "I understand, but this is a decision that will affect my family for the next 40 years. I will not be rushed." By knowing the right questions to ask and the common sales tactics to look for, you shift the power dynamic. You are no longer a passive recipient of a sales pitch. You are an active, educated investigator conducting due diligence. So now you know the questions to ask and the traps to avoid. But this brings up an even deeper issue. How do these interest rate changes fundamentally alter the DNA of the different types of permanent life insurance? Because the way a traditional whole life policy reacts is completely different from how a universal or an indexed universal life policy behaves. One might become stronger, while another could be pushed to the brink of collapse. Understanding that difference is the final key to making a truly informed decision, and that's precisely where we're going next. So let's dive into the engine room of an indexed universal life policy. Forget the glossy brochures for a moment. The single most important concept you need to grasp is something called the options budget. This is the secret sauce. It's the money the insurance company uses to buy financial instruments, specifically call options, on an index like the S&P 500. These options are what give you the potential to earn interest linked to the market's upside, without directly investing in the market itself. Now, where does this options budget money come from? It comes from the profits the insurance company makes on its own massive investment portfolio, which is called the general account. And what's in that general account? Overwhelmingly, it's bonds. Safe, steady, and for the last decade, incredibly low-yielding government and corporate bonds. You see the connection now? For over 10 years, as interest rates were pinned to the floor, the returns on the insurance company's general account were squeezed. Less profit from their bond portfolio meant a smaller options budget. A smaller options budget is the direct cause of what many IUL policyholders have experienced: shrinking caps, lower participation rates, and the introduction of spreads. The insurance company simply had less money to buy the options that generate your returns. They weren't being greedy. They were reacting to a prolonged period of historically low interest rates. But now the entire economic landscape has been flipped on its head. The Federal Reserve has raised rates at a pace we haven't seen in generations. So what happens now? As the insurance company's old, low-yielding bonds mature, they are replaced with new bonds that pay significantly higher interest. The income flowing into their general account starts to swell. More income means more profit, and more profit means a bigger options budget. This is the inflection point. A larger options budget gives the insurance company the firepower to buy more or better options. In theory, this should translate directly into better terms for you, the policyholder. It means they can raise the cap on your crediting rate. They can increase your participation rate. They can reduce or eliminate the spread. This is the fundamental reason why a rising interest rate environment can be a massive tailwind for a well-designed IUL policy. But notice I said well-designed. This is not a universal truth. This is where the path diverges, and one policy becomes a finely tuned performance vehicle, while another sputters and stalls. The tragic mistake is assuming all IULs will benefit equally. They won't. The difference lies in the chassis of the policy itself, how it was built from the ground up. Let's categorize them into two broad groups. First, you have what we can call the legacy IULs. These are often older policies designed and sold during the era of low interest rates and a roaring bull market. The sales illustrations for these policies often looked incredible, projecting high, consistent returns. But many were built on a framework that wasn't prepared for the world we live in now. Their internal costs, the cost of insurance and administrative fees, might be more aggressive. More importantly, their crediting methods are often less dynamic. They might only credit based on the average return of the entire general account, which is still weighed down by years of old, low-yield bonds. For these policies, the benefit of rising rates will be slow to arrive, like trying to fill a swimming pool through a garden hose. The rising new income is diluted by the massive pool of old money. And if the policy's internal costs are rising with age, this slow-to-arrive benefit might not be enough to keep the policy healthy. This is the IUL that is at risk of being pushed to the brink. Then you have the modern IULs. These are newer generation products, engineered in a world that understands volatility and interest rate cycles. The architects of these policies learned from the past. They built in features specifically designed to capitalize on a rising rate environment. You'll see terms like high par, high bonus, or new money crediting strategies. What this means in plain English is that the policy has a mechanism to credit you based not on the average return of the whole general account, but on the much higher yields the company is getting on its new investments. Let's make this crystal clear with an analogy. Imagine two shipping companies. Shipping Company A is the legacy model. They have a fleet of 100 ships. For the last 10 years, they've been forced to buy slow, inefficient cargo ships because that's all that was available. Now, amazing new super-fast ships are being built. They decide to upgrade, but they can only afford to replace 5 of their old ships each year. So even though they have a few new fast ships, the average speed of their entire fleet of 100 ships barely budges for years. Their delivery times for customers improve, but only fractionally. Shipping Company B is the modern model. They also have 100 ships, but they built their customer contracts differently. They told their premium customers, "Your packages will travel exclusively on our newest, fastest ships." So as soon as they buy their first 5 new super-fast ships, those premium customers immediately see their delivery times slash dramatically. They aren't held back by the average speed of the old fleet. They are benefiting directly and immediately from the new technology. In this analogy, the speed of the ships is the interest rate. The legacy IUL policyholder gets the average speed of the whole fleet. The modern IUL policyholder, with a new money crediting strategy, gets the benefit of the new, faster ships right away. This single design difference is what separates a policy that limps through a rising rate environment from one that soars. But there's one more critical piece of the puzzle you have to understand, and it's called the lag effect. This is essential for managing your expectations. An insurance company's general account is a financial behemoth, often holding hundreds of billions of dollars in bonds. When the Fed raises rates, the insurance company can't just sell all their old bonds and buy new ones. They have what's called a bond ladder, with bonds maturing at different times, some next year, some in 5 years, some in 30 years. This means that even with the best designed modern IUL, the full positive impact of higher interest rates isn't instantaneous. It takes time for the old low-yield bonds to mature and be replaced by the new high-yield bonds. This portfolio turnover can take anywhere from 12 to 36 months, or even longer, to really begin reflecting the new rate environment. So if you see rates go up today, you shouldn't expect your cap rate to double tomorrow. There will be a lag. But for a well-structured policy, the upward trend should be clear and undeniable over time. The modern shipping company is still buying the new ships one by one, but you know those faster deliveries are coming and coming soon. So the great divide is clear. On one side, you have policies that are structurally tethered to the past, slow to react, and potentially burdened by rising internal costs that could erode any new gains. On the other, you have policies engineered for today's economy, designed to capture the upside of higher rates more directly and efficiently. One is a relic, the other is a tool. Knowing which one you have or which one you're considering is no longer just a matter of optimizing returns. In this new economic era, it could be the difference between a policy that thrives and helps you build wealth and one that struggles to stay afloat. The question that's probably burning in your mind right now is, how can I tell the difference? How do I look at my own policy or a proposal I've been given and identify whether it's a legacy anchor or a modern engine? Peeling back that layer and looking at the actual mechanics and illustrations is the next crucial step. It's about learning to read the fine print, not as a victim, but as an informed analyst of your own financial future. So let's pull out that multi-page, number-filled document that makes most people's eyes glaze over. The life insurance illustration. This isn't just a sales brochure. It's a financial projection, a roadmap of potential futures for your policy. And understanding its language is like being handed the key to the entire system. You'll typically see several columns of numbers, stretching out for decades, until you're age 90, 100, or even 121. The two most important columns are usually labeled guaranteed and non-guaranteed, or some variation like current assumption. Let's start with the guaranteed column. This is the insurance company's unbreakable promise. It's the absolute worst-case scenario, legally binding and written into the contract. For a whole life policy, this column assumes the minimum guaranteed interest rate, often something like 3 or 4%, and the maximum possible charges for the cost of insurance every single year for the rest of your life. Think of it as the policy's bedrock. If every economic assumption goes wrong, if the company's investments perform at their absolute floor, this is what you are contractually owed. It's the foundation, and you should always look at it first. If the policy still functions and doesn't collapse on its guaranteed assumptions, you know you have a solid foundation. But it's not the whole story. It's the story of the old, reliable anchor. Now let's look at the non-guaranteed or current assumption column. This is where the engine comes in. This is the projection that gets everyone excited. It's based on the company's current performance, the current dividend scale for a whole life policy, or the current crediting rate for a universal life policy. And this right here is the column that is directly and powerfully influenced by the interest rate environment we're living in today. When the Federal Reserve raises interest rates, it ripples through the entire economy. For a life insurance company, which holds hundreds of billions of dollars in conservative long-term bonds, this is a massive deal. As their old, lower-yielding bonds mature, they can now reinvest that capital into new bonds paying a much higher interest rate. Their entire investment portfolio starts to generate more income. For a mutual whole life insurance company, that excess profit doesn't go to shareholders, it goes back to you, the policyholder, in the form of a dividend. So in a rising interest rate environment, the dividend scale is more likely to hold steady or even increase. That non-guaranteed column on an illustration you get today might look significantly healthier than one you would have gotten 3 years ago. The cash value grows faster, the death benefit might increase more quickly, and the point at which your dividends can pay the entire premium might arrive sooner. You are directly benefiting from the Fed's actions. For universal life or UL, the connection is even more direct. The crediting rate on these policies is often explicitly tied to the performance of the company's bond portfolio. Higher rates mean higher yields, which can translate directly into a higher crediting rate for your cash value. This is fantastic news if you have one of these policies. More interest means your cash value compounds faster, which helps it overcome the internal costs of insurance, keeping your policy healthy and your premiums stable, or even allowing you to reduce them in the future. But here's where we have to introduce a massive flashing warning sign. It's called Indexed Universal Life, or IUL, and the relationship with interest rates here is far more complex, and frankly far more dangerous if you don't understand it. With an IUL, your cash value's growth isn't tied directly to an interest rate, but to the performance of a stock market index like the S&P 500. The company offers you a floor, usually 0%, so you can't lose money if the market crashes. But in exchange, they also set a cap, which is the maximum return you can get. If the market goes up 20% but your cap is 9%, you get 9%. You might think rising interest rates don't matter here. You're linked to the stock market, right? Wrong. How does the insurance company afford to give you that 0% floor and still link you to market upside? They use the interest they earn on their bond portfolio to buy options on the stock market. Those options are what give you the potential for growth. And here is the critical point. When interest rates rise, the cost of those options, the very tool that generates your return, also tends to rise. Think about it. The insurer has a budget to buy these options, and that budget is funded by the interest they earn. If the price of the options goes up, their budget doesn't go as far. They can't buy as much upside potential. So what do? They lower your cap. We are in a bizarre situation right now where many IUL carriers are lowering their caps, even as interest rates are rising. They're telling you the cost of providing the protection and the upside is getting more expensive, so your potential reward has to shrink. This is a profoundly counterintuitive concept that trips up even some financial professionals. And it's a trap for the uninformed consumer who just assumes, rates up, good for everything. This is why looking at an illustration from a single point in time is like trying to navigate the ocean by looking at a single snapshot of a wave. Tells you nothing about the tide. We have a painful history lesson on this. In the 1980s, interest rates were in the double digits. Life insurance illustrations from that era were projecting incredible, life-changing returns. People bought policies based on these rosy scenarios, believing their premiums would vanish in 7 or 10 years as the cash value exploded upwards. Then, for the next 40 years, interest rates steadily fell. Those 12% projections became 8%, then 6%, then 4%. The policies began to starve. The cash value growth wasn't nearly enough to support the ever-increasing internal cost of insurance for an aging policyholder. The vanishing premiums never vanished. Instead, people in their 60s and 70s started getting letters demanding they either start paying massively increased premiums or watch their policies, which they paid into for decades, lapse and become worthless. It was a financial catastrophe for an entire generation of policyholders who trusted the illustration. We are at risk of a similar but inverted mistake today. An illustration run in today's higher rate environment will look fantastic. It will show strong growth and promising outcomes. But what if 5 or 10 years from now, the economy shifts and the Fed starts cutting rates again? That current assumption column will prove to have been a fleeting fantasy. This is why you must learn to stress test your illustration. Don't just accept the beautiful picture the agent shows you. You have to become a pragmatic skeptic. Ask them, "This looks great. Now, can you please rerun this illustration and show me what it looks like if the dividend or crediting rate drops by 1%? What about 2%? Watch what happens to the numbers. Does the policy still survive? Does the premium you need to pay suddenly skyrocket in year 20? If a small change in the long-term assumptions creates a catastrophic failure down the road, you are looking at a brittle policy design. Pay close attention to the crossover point, the year where the internal growth is projected to be larger than the premium you're paying. How sensitive is that date to a change in the interest rate assumption? If a 1% drop in the projected return pushes that crossover point out by 15 years, you know the policy is running on a knife's edge. It has no margin for error, and the one thing we know about the future is that it will never perfectly match our projections. A small change in an annual interest rate doesn't just have a small effect over 30 or 40 years. It's a lever. Compounding is a powerful force, and a tiny difference in the early years becomes a chasm of difference in the later years. So now you know how to read the map. You can see the mountains of the non-guaranteed projections and the bedrock valleys of the guaranteed promises. You can see how the tides of interest rates can either lift your ship or leave it stranded. But reading the map is one thing. Choosing the right path, avoiding the hidden reefs of policy costs, and actually reaching your destination, that's the final piece of the puzzle. That's where strategy moves beyond analysis. So what does this strategic navigation actually look like? It means moving from a passive policy owner to an active, informed CEO of your own financial protection. Let's break down the specific game plan based on where you are in your life insurance journey. First, for those of you who are currently shopping for a new policy, you are in a surprisingly advantageous position. For years, low interest rates acted as a headwind for insurance companies, often resulting in higher premiums for permanent policies. Now, with rates rising, that headwind is turning into a tailwind. When you look at a new permanent policy, whether it's whole life or universal life, you have the opportunity to lock in a product designed in a more favorable rate environment. Your strategy is one of meticulous comparison. When an agent shows you a policy illustration, your eyes should go to two numbers. First, the non-guaranteed projection, which is based on the company's current dividend scale or crediting rate. This is the optimistic scenario, and in a rising rate environment it might look very attractive. But the second, and arguably more important number, is the guaranteed minimum. This is the absolute floor. This is the worst-case scenario the insurance company contractually promises to deliver. Your job is to ask, if this policy only ever performs at its guaranteed minimum, will it still meet my goals? Will it still be in force when I need it? A good policy in today's environment will have a compelling non-guaranteed projection, but a rock-solid, acceptable guaranteed one. The gap between those two numbers tells you the real level of risk you're taking on. Higher interest rates can make both of those numbers look better than they have in a decade. Now, let's talk to the millions of you who already own a whole life policy from a mutual insurance company. You are a part owner of that company, and when the company does well, when its investments bolstered by higher interest rates perform better, you share in the profits through dividends. Your strategy is to actively manage these dividends. For years, you might have had them set on autopilot. It's time for a review. You typically have several options. You can take the dividend in cash, which is a nice annual bonus but does nothing to improve your policy. You can use it to reduce your premiums, which frees up cash flow. Or, and this is often the most powerful option, you can use the dividends to purchase paid-up additions. Think of paid-up additions as tiny, single-premium life insurance policies that are fully paid for. They have their own death benefit and their own cash value, and they also earn future dividends. In a rising rate environment, your annual dividend can buy more of these paid-up additions. This is how you compound your growth. It's like reinvesting dividends in a stock portfolio. Over time, this strategy can dramatically increase both your total cash value and your total death benefit. far beyond the original projections. Your action item is to call your insurer or agent and request a projection showing the long-term impact of each dividend option. The difference could be hundreds of thousands of dollars. Next, and this is the most critical group, are those of you with existing universal life, indexed universal life, or variable universal life policies. For you, rising interest rates are a double-edged sword, and your immediate strategy is to conduct a policy stress test. This is not optional, it is essential. You need to find out if your policy is healthy enough to survive. Here's exactly how you do it. You call your insurance company, and you request an in-force illustration. This is not your original sales illustration. This is a snapshot of your policy's future based on its current cash value and the current economic environment. But you don't just ask for one. You ask for three. First, ask for an illustration based on the current crediting rate, assuming you continue to pay your current premium. This shows you the best case, optimistic path forward. Second, and this is the one that matters most, you ask for an illustration based on the guaranteed minimum crediting rate. This shows you the absolute worst-case scenario. The results of this illustration will tell you if your policy is on a collision course with disaster. It will show you the exact age at which your policy's cash value will hit zero, and the coverage will lapse, even if you keep paying your premiums. If that age is younger than your life expectancy, you have a serious problem. The third illustration you request is the solution finder. You ask them, what is the minimum premium I need to pay to guarantee the policy to age 100 or age 121? This is called solving for the no-lapse guarantee premium. The number they give you might be higher than what you're currently paying, but it provides certainty. Once you have these three reports, you can make an informed decision. If the stress test reveals your policy is underfunded and at risk of lapsing, you have a few choices. You can start paying the higher premium needed to guarantee it. You can explore a 1035 exchange, which allows you to roll your existing cash value into a newer, potentially better performing policy tax-free. Or, you could consider reducing the death benefit to lower the internal costs and make your current premiums more effective. The worst thing you can do is nothing. Hope is not a strategy when it comes to a UL policy in a volatile interest rate environment. Now, a crucial word of caution for everyone. Do not rush to cancel an old policy. Your most valuable asset might not be your policy's cash value, but your original health rating. If your health has declined since you first bought coverage, you may never be able to get a new policy at a comparable price or at all. The first step is always to analyze and repair your existing policy if possible. Replacement should be the last resort, handled with extreme care and the guidance of a professional. This brings us to the final overarching strategy that applies to everyone. Don't go it alone. The world of permanent life insurance is complex, filled with jargon, contractual nuances, and financial variables that can change over time. Trying to navigate this alone is like performing surgery on yourself by watching a video. You need an expert. Your mission is to find a qualified, independent financial advisor or insurance agent who has a fiduciary or best interest duty to you. Look for someone who is not a captive agent of a single company, but who represents many carriers and can objectively assess your situation. They should be able to model the stress tests I described, explain the trade-offs of different dividend options, and help you compare new products on an apples-to-apples basis. They are your financial co-pilot, helping you read the instruments when you fly into economic turbulence. In the end, the story of interest rates in your life insurance is a story about control. For too long, people have bought these policies and then filed them away, hoping for the best. But hope is a fragile foundation for a family's future. The economic shifts we're seeing are a wake-up call. They are a powerful reminder that your life insurance is not a static document. It's a dynamic financial asset that needs to be managed. The interest rate hikes by the Federal Reserve were not designed with your life insurance policy in mind, but they are impacting it all the same. By understanding how, you've taken the first step from being a passenger to being the pilot. You now know more than 99% of policyholders out there. You know that rising rates can be an opportunity for new buyers and whole life owners. You know they can be a hidden danger for underfunded universal life policies. And most importantly, you know the exact questions to ask and the specific actions to take. Your financial future isn't built on a single decision you made years ago. It's built on a series of small, informed course corrections you make along the way. This is one of those moments. This is your chance to look under the hood, to run the diagnostics, and to ensure the financial engine you built for your loved ones will be there for them when they need it most. The single most powerful tool at your disposal is that in-force illustration. It's your policy's X-ray. It shows you what's really going on inside. Your journey doesn't end with this video. It begins with that phone call to your insurance company. In the comments below, I want you to share your experience. Have you ever requested an in-force illustration? Were you surprised by what you found? Your story could be the catalyst that encourages someone else to take that critical step. And if this deep dive has armed you with the clarity you need, subscribing ensures you'll be the first to know when we break down the next major financial force that could be silently shaping your life. Take control. Ask the questions. Secure your future.